right, everybody, welcome back to another episode of the Evernest Real Estate Investor Podcast. I am your host, Spencer Sutton, and I'm here with my two co-hosts. All three of us are back together again. It's been a while, I think, since all three of us have been here, hadn't it? Gray, you and I have been doing a lot of recording, just the two of us.
And even the last one was just me. It was kind of nice. I'm kind of sad to have both y'all back, if I'm being honest.
Hey, how did you do? I haven't listened to the podcast. It's being produced right now, but how did you do just going solo?
I mean, 10 out of 10, no doubt in my mind. And at least better than both of you would be my final answer.
Yeah. Well, I can't wait until you do one solo without a guest. That's going to be the true testament of how good you do.
Yeah. Got to be practicing in the mirror for that one. Don't know if I've got 45 minutes in me of a monologue yet on real estate. Coming then. We're working on it.
Spencer's actually getting really good at that. I was really impressed. He did some training for our team and that we all looked at this week. And I was really impressed with the training. So kudos to you, Spencer, for the great monologue training. I
was waiting for the punchline here. That was like a genuine compliment, you know? You don't hear that a lot.
And I did.
I'm glad I'm recording.
Yeah. And I honestly didn't really want to give that, but you got to speak the truth.
Well, the funny thing is when I got on to do that recording, I just thought to myself, okay, I know how much I don't like to pull up a video that we need to and see like a 30 or 40 minute video. So how quickly can I do this and still get my point across? So that probably actually helped a little bit.
And I did play you at 1.5 times, and you're way better at 1.5 times than you are at 1 times, by the way.
So much smarter for sure. All right. Well, glad the gang's back together. Today, what we thought we would do, there are a lot of changes in the market, and we are getting our agents, our property managers are hearing from investors from around the country, and they're asking them, hey, what are y'all seeing in the market? So we thought we'd come on and do just a quick market update for this episode because we think this is something you all want to hear. And there are a lot of changes. And so we're going to walk through some of the key points as we're ending July, moving into August. And just yesterday, the Fed raised rates 75 basis points. So why don't we kick off there from a macro standpoint? Gray, what do you see in the market?
Yeah, I was talking about this the other day, and we don't realize how good we had it with 2 years of sub 3. The rates just rapidly increased, and then they've kind of been stabilized for the past couple of months. So a lot of the conversations that we've been having with investors is how much more will they continue to increase? Because at the rate that they were changing, so they were going up every month, and they kind of projected some 1% increases. It's hard to predict out pricing. If you go under contract, is the market going to soften? So from a macro standpoint, we had homes that were still on the market when they were put up with like really low interest rates. And so typically home prices are slow to kind of react. But what we have seen is inflation has driven down the demand. So there's less buyers out there because people can afford less. And the supply is also at the same time increasing. So we're seeing the shift from past 2 years was a heavy seller's market, extreme demand. Yeah. You could afford a lot. There weren't houses on the market due to COVID. Now we're really kind of coming out of that. And so from a macro standpoint, things have rapidly changed even just from 6 months ago. But the big change we haven't seen is really kind of massive price adjustment. There's been no housing crash. Right. So we've seen that interest rate get ticked up. It just takes a while to kind of bleed into the market because some buyers have, they might lock in the rate for 90 days. So these kind of have some long tail things. So when you hear 75 basis points, that's not going to affect prices today. That's probably going to affect prices in 90 or 120 days.
So let me ask you this, because you mentioned buyers have less purchasing power when rates, increase. What do you think about also with inflation? There's other factors that are like decreasing their buying power, groceries going up, gas going up, things like that, just kind of across the board, like the ability to purchase is kind of being dwindling. Is that taking, like, do you see that in the market at all? Is that playing into it?
No, I don't know necessarily. I was reading something interesting about inflation and how it's weighted, and housing is a big component of that. Housing and then gas, but we've seen gas tick down, I think 2 weeks in a row, kind of every day it's slowly ticked down. So some markets are kind of sub 4 on that. So haven't seen that as affect as much. I think people who've got the ability to invest in houses, a lot of times they have that kind of money. They've already got that money put away. Now, some investors might be off because they might be fearful of what this means. Haven't seen that as affect as much, kind of on the inflation side. But what I think that does drive people to do is they want their cash working for them. So it's just a really interesting time in the market where you've got typically you raise interest rates and that helps to slow down kind of an overheated market, but we also have this inflation. And so it's kind of these like interesting factors that we haven't really seen in, the past 20 years in the economy.
Yeah, I'll jump in here. I think it's kind of interesting that interest rates went up yesterday, but mortgage rates went down today. That means that they were already probably pricing that in. They expected that to happen. So mortgage rates have dropped actually since yesterday. And so the way I keep thinking about it is being opportunistic. And I believe there's a lot of people, and we're starting to see this in some of the data. There's some institutions that are sitting on the sidelines trying to see how this shakes out. There are some retail investors that are sitting on the sidelines trying to see how this shakes out. And I think that there's some savvy investors out there that will take this as an opportunity where you don't have as much competition and you can go and really find some great deals in the market. Maybe not buy as many houses as you would have in the past, but what a great time when you have other people sitting on the sidelines to be super opportunistic.
Yeah, there's a lot of fear just in terms of, hey, what's going to happen in the future? Am I overbuying now? I've seen a lot of investors just kind of, instead of getting pretty close to list price, I think there's sellers out there that are feeling the pain. We've seen average days on market has risen. If there are less buyers in the field, both on the homeowner and the investor side, if you're opportunistic, like Matthew's talking about, and you send out, maybe increase the amount of offers that you're sending and send them at 80, 85, % of list price to see if somebody's out there that kind of is feeling some pain. Maybe they just need to sell and maybe you can help solve their problem. But if they just have, 30 days, they've got no offers, they might be willing to take an offer that's 20, 30, 40 grand below list if kind of their situation needs them to sell. So I have seen buyers kind of be opportunistic in that sense where, either there's this lull and then interest rates kind of stabilize, prices start to readjust and the buying pickbacks up. Like that seems like the most likely kind of thing. So we might be in this window where there's less buyers out there and you can go out and get a better deal.
Why is it that the institutions you think are on the sideline? When you say waiting to see things shake out, is that more from because I'm just imagining they've got a lot of cash. And so, or is it waiting for prices to kind of settle down, see if things drop a little bit further so they can get better deals?
Yeah, the way they look at it is they're buying tons of houses. And so they have to look at it more on a macro level. And so they're thinking where is debt going to get priced for us once we basically stabilize this portfolio? And when there's a big question mark in their mind, that creates risk. And so they want to wait and see where things level out. So, everybody will agree that 90, 120 days ago, everything was fairly steady Eddie. And we're going to get back to a steady Eddie place. And so everybody's, all the institutions, I shouldn't say all of the institutions, but some of the institutions are sitting back and waiting to get more to a more stabilized environment. And so what I would say, like zooming out, especially for the small time retail investor, if I was going to zoom out and then, ask myself some questions, where are the good deals right now? There's still places around the country where there are good deals, and, painting the whole United States real estate market with a broad brush just seems it's really hard to do. So, we're looking at some of the data. Days on market is down in about half of our markets and up in the other half. And in one of our markets is actually up 118%. That's in Huntsville, Alabama. And so, where are the good deals? The second thing I would ask myself is, where are people moving? So demographic information would suggest that people are moving to the South. And so, being mindful of where people are going is going to create more demand. Ultimately, that's going to drive the prices up. So you buy at today's price, not only is it going to, and today's rent, not only is it going to go, the price of the house going to go up, but the rent's going to also go up as well, because as you increase demand, then you can charge more for the house. And so like you can still find great deals if you're not dealing in a kind of a macro world like those institutional investors. You need to zoom in and find where are those good deals and then go pursue those.
A lot of times finding these good deals is really a lot of, kind of what you were saying, Gray, is finding the sellers who are motivated, right? So they are out there. There's always going to be motivated sellers for one reason or another. It could be they're a little bit spooked by the market, but it could be, hey, they just got life circumstances are happening and they need to sell. But to Matthew's point, in some of our markets, I would say like in a tertiary market like a Birmingham or a Little Rock, you haven't had these huge swings, so you probably are not going to see major softening in the market in these places.
It is interesting looking. I mean, places like Nashville, Denver, some of these kind of bigger cities where people are moving to, those markets probably got the most overheated. But if you look at year-over-year price drops, Denver's up 250%, and Nashville's up 237%. So that meaning 237% of listings have a price drop. And so they kept pricing in and up and up and up. And that's where you list and get 30 kind of K over above. Those markets might be feeling more pain than Columbus, Ohio. They only have 27% kind of year over year. So it's not just kind of macro. I mean, pick the markets that you like and start to look into some of this data. And then the second point that kind of keeps ringing around in my mind, we're still able to push rents. Like there is still a low supply of good single family rental houses. And so like I was looking at with our agent in Nashville, it's tough to find really good cash flowing deals in Nashville, but a lot of people are moving. Tennessee is a state where a lot of people are moving. So what does that rent look like when you buy a $300,000 house and the rent is $1,800 right now? In 5 or 10 years, if your basis is $300 and you can get that rent to $2,700, $2,800, $2,900, and growing city is likely going to appreciate. I mean, having a 10-year kind of time frame resets some of this and takes you out of the, hey, what are rates doing today? And picking markets that you believe in the long term, that rent's going to grow. Because that ultimately is probably going to lead to the most success. Is if rents are growing, likely home prices are also going to appreciate.
I mean, do you all see, I just see like this demand for rental property continuing to grow, even in these uncertain markets. I mean, I'm just thinking about, we've been having discussions about homeowners who maybe they don't want to sell their mortgage that they're sitting on a 3% mortgage on a nice house. Instead of selling that house, they just decide to rent it, and then they'll go and rent something else. Because it's almost like the mindset in America now is shifting. Like renting used to be, it's you've got to buy. Now it's like become a more favorable, more acceptable. It doesn't lower your status, I guess, is what I'm trying to say.
There's no doubt, especially right now. I saw some data that says, it's a John Burns study that says it's actually cheaper to rent in most markets than it is to buy. So if you think about it, if I have a house in Nashville and I have a 2 point something or 3 point something mortgage, and then I move to a place like Columbus, Ohio, I'm going to keep that house in Nashville and rent essentially at a cheaper. It's going to be cheaper for me to rent. And it just makes financial sense for somebody to do that.
And it's even, I was looking at some John Burns data end of last year. It was still pretty balanced. Like there were a lot of markets where it still was cheaper to own. Since the interest rates have gone up, that number has flipped. I think we've also seen kind of like buyer preference. I think having better single family rentals, because there have been people who've invested, but like really, I mean, the single family kind of asset class really has kind of come to age in the past 10 or 12 years, where you've got bigger groups that typically do apartments, might be doing single families now. They can offer amenities. They might be build for rent communities. It might be just a better product out there. And I think people like flexibility. And then I think we're still seeing effects of COVID and that pushing people to want more space. I think the interesting thing on the supply side is the percentage of investors buying homes has grown. So it's still a really small percent of all the single family homes. It's still not even close to a majority of all the homes being bought by either institutions or small investors. But what's interesting is like as that share grows, those houses typically aren't ever going back on the rental market, especially if institutions are buying these or professional groups. It's kind of like that becomes a forever rental home and that might be traded amongst groups. And if we're still low on the supply side, then that all those things point to rents are going to continue to grow up. And so kind of the macro, like, yeah, we're talking about the micro here and kind of what's going on now. The same macro principles still apply that they did 6 months, 12 months. And so we're kind of continually, as we look at the market, like I'm looking at it and saying, hey, is the data that we were looking at 6 months ago, how is that playing out? And is that still ringing true? So the short term might be kind of up and down. Prices may go up, they may go down slightly, but I think rents will probably continue to rise, which is why buying now could still make sense depending on your scenario.
I would also like to point out somebody who may be a perfect time to jump into the real estate market would be somebody that has a lot of cash. Maybe they sold a business, they cashed out, some other big commercial real estate. But if you have a lot of cash, now would be a great time to jump in, right? Because everybody else is worried about their mortgage and how much that, and you don't have to worry about that. And so what a better way when the market's the stock market's a little bit choppy, what a better way to put money into something that typically will float. And over time, we know it'll float with inflation. And of course, as rents continue to rise, the property will appreciate. I mean, all these things should float along with inflation. And so your appreciation should outpace that. So if you had a bunch of cash, what an awesome time to jump into the market and buy some single family, small multifamily real estate.
And one point that Spence brought up as we were kind of talking before this was, so we've shifted from really hot sellers market, like it was completely sellers market, buyers had no leverage. It shifted a little bit. And so there's kind of this recency bias to say, hey, the market is 10 times worse than it was. We were looking at some of the data that comparing to 2019 to now, like the market's still way hotter now than it was in 2019. So I think it's good to have that perspective. Just kind of like in 2019, we would have said that we had a pretty strong economy, right? And so we're still kind of like on the way to revert to the mean, just in terms of like a normal market. And so I think that's good context, just if you're trying to like put this into context over kind of where we at historically, like we're still in a really hot market. And when that happens, I mean, prices tend to at least stay flat, if not continue to go up.
Well, what happens to people is they start watching the news and all they hear about is gas prices and inflation and everything and housing. And so they tend to think, oh, it's getting really, really bad. But in reality, just, 2 years ago, 3 years ago, it's still a lot better than it was.
Yeah. I mean, but it is nice. I mean, if you're an investor out there, you can be choosier. You don't have to, as soon as the house sits on Friday, you got to make an offer and there's 30 offers on it. I mean, that's kind of more of the market right now. I think the other opportunity, speaking in this market, so now this kind of, when homes set and there is pain from the seller, so the house is out there 30, 45 days and they really want to sell, I think there's an opportunity that you didn't have the past 2 years, which is potentially seller financing, some more creative financing. So we've done some other episodes and have talked about that. But if an owner owns a home free and clear, you could potentially create a deal that works for them where they still get paid monthly, but they don't have to, pay capital gains on that if that's not what they want. If they want continued income, but they just want to be done being a landlord. Now, when you get a cash offer and you can just walk away, you might not do that, but you might be able to give them a better price than they would get from a homeowner, or if there's less cash offers on it and you can structure a deal where you have to put less money down. That could be another opportunity that I see coming back now, with just homes sitting on the market a little bit longer and the sellers having a lot less leverage than they did even 6 months ago.
Yeah, we used to see that a lot with investor to investor deals, like selling portfolios. People used to do that all the time, seller finance.
We were actually having an internal conversation yesterday about this very thing. Like there seems to be an arbitrage opportunity and, how can we take advantage of it as investors? And so Stan, our CFO, me, Graham, we were all sitting around the table just talking about, how could we get creative out there and buy real estate using everybody else's 3% mortgage.
Yeah.
We didn't come up with an answer.
Well, some of those are assumable. Like I've seen some people on Twitter talk about that, where in the fine print, that 3% loan was assumable. So you could structure a deal in a creative way where you put some cash down, you assume a portion of the loan. And how awesome would that be when rates are at 6% right now? Like you could afford to pay a little bit more if you only had to pay 3% on that rate.
Yep.
So there's, look, lots of ways to kind of get it done. And those are kind of it comes back into, hey, you don't have to have cash, you don't have to be the highest bidder, but it stirs a little bit of the creativity. And so I think you can be probably a little bit more, sniper and just kind of focused and try to get some of the best deals that still cash flow right now, opposed to more shotgun, which is kind of felt like the past 2 years.
Yes. So, Matthew, do you want to say anything else?
Well,
about to say
the last thing I would say is, just taking a step back, and I think Gray mentioned this even earlier, but from a macro standpoint, there's still this huge group of people that are moving into the market. In other words, we're still underbuilt. And so if I'm taking an investor's view, long-term view, hey, I'm going to buy a rental property for the long term, I'm going to find out where everybody's going to live and where this big kind of bulge of people are going to come into the market. And, by some people's estimates, it's 5 million people or 5 million households still need to be built just to meet the demand of what's coming. So we're still in a really good spot, and obviously things have changed, but just making wise decisions and investing for the long term. Again, real estate's, it's hard to go wrong over long periods of time with real estate.
All right, gentlemen, I would say, and we've been talking a lot about the macro, but if you want to get into the micro, if you want to dig into more of the local market, then you can absolutely reach out to one of our agents, one of our brokers that are in the market. They'll be happy to talk to you about what they're actually seeing on the ground in any one of our markets, which we're in 25 now. So there's a lot to choose from. So go to our website, evernest.co, check it out, and reach out to any one of them if you're interested to learn more about what's going on locally, and leave us a review. We will be back next week with another episode of the Evernest Real Estate Investor Podcast.